Also, if you can elaborate, like you already took an example to explain like how the pricing of futures affect the straddle prices, right? But if you can just go in a bit detail and explain how, if let's say in one future a future contract is in contango, another was in backwardation, okay, and we want to trade options on those, so how that will affect the pricing of the option, just in between more detail.
Yeah, so if you're well, the one of the main question. So we have an interesting question here about like it comes back to what we think a futures term structure represents.
Yeah.
So you can have one school of thought which thinks that the futures term structure is a predictor of where the future is going to be at some date in the future. And you could have another theory that says, well, I think that the futures, the deferred future is just reflecting the demand to hedge, say 12 months hence. But that future will likely roll down to the current spot price. So in other words, it's not a predictor, it's just the price required to clear the flows to hedge in the back month. So maybe if we take something like maybe there's a bunch of let's say you're looking at a market like coffee and there's all this demand to buy coffee in the future because there's concerns about the coffee supply. So there's a lot of demand to buy deferred coffee futures, and that demand is clearing at a higher price than the current spot price. It doesn't necessarily mean that the coffee future in the future is going to be there. So what that has an interesting even this difference in what you believe the futures market is saying has different indications for how you think like a vertical spread should be priced. So for example, if I thought that the 12-month future is going to roll down to the spot price, then I would expect that a put spread on the back month future should have should be more expensive to buy. In other words, its skew should be flatter. Its put skew should be flatter than a nearer dated future, because I would expect that the longer dated put spreads should be more expensive to buy. Because it is more likely than not that that future rolls down. It's almost as if there's a drift in that future. And if there's a drift in it, then you should expect that to be reflected in the option surface. So that is one example of why how the options in commodities could vary simply based upon what your belief is about what the futures term structure means.